Welcome everybody to Private Asset Management's virtual economic and financial market outlook. My name is Alex Dietz and I work on the research team as an analyst. I'll also be the host of today's meeting. Our presentation will be roughly 45 minutes long with an opportunity to get some of your questions answered at the end of the presentation. To ask a question, please use the chat function in Zoom and send it to Alex Dietz. Feel free to send your question over at any point during the presentation. With that being said, I'd like to introduce our speakers. I'm sure a lot of you are familiar with our Chief Investment Officer, Jeff Witt, from previous presentations. As always, he'll be covering the financial markets. Given the unprecedented economic disruption we've seen in 2020, we thought it'd be prudent to include our Chief Economist, David Allen, for his views on the economy. But before we get started, just a quick word from our friendly lawyers. The views and opinions expressed herein are as of the date recorded and should not be construed as an offer to buy or sell any securities. Such views and opinions may differ from those of Private Asset Management or its affiliates and are subject to change without notice. Private Asset Management has no obligation to provide updates or changes. With that being said, let's get started. David, I'll hand it off to you to start with the economy.
Great. Thanks so much, Alex. And thank you all for being here. Very excited to get an opportunity to speak with everyone today. This is our firm's first Zoom presentation. We would obviously much prefer to be with you in person to be able to have this discussion, but given the circumstances, this seems like a great option. I'm excited about the opportunity to connect with everyone and discuss the economy and discuss financial markets, and then have some Q&A at the end of our presentation. Jumping into our review of the economy. Obviously, the conditions that we're seeing right now are extraordinary and largely unprecedented. There's also a great deal of uncertainty that we're seeing in the economy right now. Some of that uncertainty stems from unknowns about the path of the pandemic, how it will continue to impact public health. There's also a lot of uncertainty as it relates to public health policy, fiscal policy, and monetary policy, and how those will all commingle to impact economic output. And then finally, there's uncertainty about how consumers and businesses will react. We're beginning to see lockdown conditions ease across the country, but what remains to be seen is how consumers and businesses are going to react as we begin to ease our lockdowns. One thing that I think is more certain, is that there are signs in the economy right now that things are beginning to improve. A lot of that data comes out of the labor market, which was sort of the first area of the economy that was impacted by the coronavirus. But we're beginning to see there the first signs of improvement. Just a roadmap for the review of the economy. I'd like to talk about some of those signs of improvement, but also provide some context for those improvements, and then move into our outlook for economic growth over the rest of this year and into 2021. And then a review of what we see as potential future policy actions from the Federal Reserve and the federal government. And then finally, I'd like to offer sort of a model that we've been using to sort of imagine what a post-pandemic economy might look like. Okay. So beginning here with the labor market, this is sort of the first sign of improvement that I'd like to go over. It's probably the one that is the most fresh in your mind. This is the unemployment situation report that was released last week. It was obviously a big surprise. We saw 2.5 million jobs added. The consensus estimate heading into the report was for a 7.5 million job decline, so a 10 million job miss by consensus there. The chart we're looking at here is the month-over-month change in payrolls by industry. So in red, we have April, which saw steep declines in payrolls, and then May, when we saw some recovery. As you can see, where gains were greatest in May, we saw those were the hardest hit industries in April. So first and foremost, leisure and hospitality, which includes restaurants and hotels, saw 1.2 million jobs added in a month. Construction, education, and health services also were big gainers for the month of May. Meanwhile, government payrolls was sort of the biggest loser in terms of the May jobs report, where we saw jobs lost of about 600,000. A lot of those happening not just at the federal level, but at the state and local level also. So with these job gains, we did see the unemployment rate fall to 13.3% reported, down from 14.7%. I say reported because there's been quite a bit of a debate about the validity of that 13.3%. There were some classification issues with the way that furloughed workers were being counted in the survey. And so even the Bureau of Labor Statistics indicated that the actual unemployment rate were survey respondents classified correctly, maybe as much as 3 percentage points higher than what we saw actually reported. Nevertheless, it's an improvement in the labor market. But again, I'd like to add some context here. So this is a look at employment to population, which just shows, I think, how steeply we've fallen from what we considered a very strong labor market prior to the pandemic. Unemployment is still higher than during the Great Depression. Even though we added 2.5 million jobs in May, we still lost a net over 19 million, which is roughly 13% of pre-pandemic employment. So there's something positive to take from the most recent jobs report, but just a reminder that we have a long way to go, and we need several more very good reports before we begin to reclaim the prior strength in the labor market. Turning now to our second sort of indication in the labor market that things are beginning to improve. This is initial unemployment claims. For most of the time that I've been with private asset management, this has been a pretty boring economic indicator. It basically trends between 200,000 and 250,000 on a weekly basis. But during the pandemic, it's become it has renewed importance, mostly because it's reported so frequently. So again, it's reported on a weekly basis, and so it's offered a nearly real-time look at sort of how labor market trends are moving right now. So what we're looking at here in red is a state program unemployment claims. So those are the traditional claims that you should be familiar with. But then in black, over the last 7 weeks, we also have this federal program. The federal program is providing unemployment benefits to classes of workers that otherwise wouldn't be eligible for unemployment benefits, those being self-employed workers, independent contractors, and gig workers. And so those are the claims we're seeing here in black. So initial claims peaked at 6.9 million in the week ended March 27th, but has trended down steadily, down to 2.5 million for the most recent data point, which is for the week of May 29th. That's a 10.5% decline week over week, sustained over that period of time, which is great to see. So this decline is a positive that we should take and a sign that labor market conditions are improving. But that 10.5% decline week over week, it would still take 22 weeks for us to return to pre-pandemic levels if we sort of carried out the same rate of decline moving forward. So although this is trending in the right direction, again, we have some ways to go before we return to pre-pandemic levels of strength. Moving on now to continuing claims. So we've seen initial claims are trending down, and so perhaps they're going to become a little bit less of an area of focus, and continuing claims are going to be more of an area that we'll be paying more attention to. So continuing claims are just people who are no longer initial claims, but there's just the accumulation of unemployment claims in the economy. So right now we're at 30 million in terms of continuing claims. That's for the week ended May 15th. Which is the most recent data point available. Prior to the pandemic, this was right around 2 million. So again, this is trending in the right direction, at least in the most recent data point. But we have a lot of room to fall before we get back down to normalized levels. So moving now on to my outlook for what's these people who are on continuing claims that are unemployed. What's the likelihood that they're going to be rejoining the labor force near term? I'd like to just point out one indicator that I think provides some insight here, and that's small business hiring plans. This is from the Small Business Optimism Index report. We've seen some improvement here recently. In the most recent report for May, a net 8% of small businesses are planning to increase staff in the future. That's an increase from a net 1% in the April report. But prior to the pandemic in February, we were at 21%. So it does seem like small businesses are moving towards beginning to see adding to payrolls in the future, but we still again have a long way to go. So moving now into our outlook for growth as we proceed through the summer and into 2021. I think one of the most frequently cited statistics in the financial media is that the U.S. is a consumer-driven economy, that consumption accounts for 70% of overall U.S. GDP. What's perhaps less frequently mentioned is that it's also often the biggest driver of growth. That's what that we see in this chart. This is a look at contributions to overall GDP growth on a quarterly basis, going back several quarters. As you can see, the red area, which accounts for personal consumption, makes the largest contribution in more cases than not. So I think that's where we should start. Let's look at the consumer, and let's get an idea of where growth might trend moving forward, beginning with the consumer. In April, consumer spending fell a steep 13.6% after a 7% decline in March. That decline in spending was pretty broad-based. We saw a 16.5% decline in spending on goods, while spending on services fell 12.2%. The areas of consumption that were hardest hit are probably those that you would expect. Recreation services was down nearly 43% on a month-over-month basis, and food services and accommodation were down about 35%. So that data is perhaps not as current as some of the other labor market data we have, but it certainly is painting a pretty dire picture. Some more recent data from third-party sources suggests that consumers are beginning to spend, closer to what a normal spending pattern would be. Examples of that: purchases of toilet paper are down 63% from their peak during the pandemic. Also, sales of disinfectant are down about 83%. Sales at grocery stores are still elevated, but they're down about 20% above normal levels, but they're down pretty significantly from where they were earlier over the last couple of months. So while the data from the consumer side doesn't necessarily show improvement as of yet, I think there are some indications that consumers are sort of out of the panic buying mode and returning more to normal patterns of consumption. Another reason that we are optimistic about consumer spending moving forward comes from the personal income data that we've seen. So personal incomes in April actually increased 10%, over 10%. But it might be surprising considering the declines we saw in the labor market. Wages and salaries actually declined 8%, but the personal incomes overall, including transfer payments from the government, so these are the things like the stimulus payments that households received and unemployment benefits from state and federal programs, those combined allowed personal incomes overall to increase 10%. So if we have incomes increasing and consumption decreasing, the balance there is that the savings rate has increased materially, up to 33%. One way that we look at that savings rate at 33% is that that's a nice reservoir for future consumption as consumers begin to feel more comfortable. And a good gauge of how consumers are feeling is, of course, the Consumer Sentiment Index, shown here in dark red. It's fallen pretty sharply, 101 in February down to 72.3 in the most recent reading. Digging into some of the underlying data in this index, I think initially we were happy to see. So I'm talking about the sub-indices of current conditions and expectations. So current conditions, which as the name would suggest, are sort of how consumers are feeling about their positioning today, fell 40 points from February to April. But expectations, which are sort of longer term views, fell just 22 points over the same time period. So to us, this suggested that consumers initially were seeing the pandemic as a very near-term concern and not something that they saw affecting them moving further out into the future. Unfortunately, in May, we saw a slight reversal here. Current conditions actually improved in the May report by 8 points, while expectations fell a further 4.2 points. So that reversal there remains to be seen if that'll be carried out. It may be that some of the stimulus payments from the government and unemployment benefits reached consumers in May, and that may be why their current conditions, why their perception of current conditions improved for the month. So we have another report coming out on Friday for consumer sentiment, so it'll be nice to see how these three indices together are trending on Friday. Turning now from the consumer to our outlook for business investment, that's often sort of in the most robust economic environments, businesses are out investing and driving economic growth that way. We unfortunately don't have much, it's hard to generate a lot of optimism about business investment in this environment. One reason is that just trending sort of even prior to the pandemic, private investment was down for 4 consecutive quarters, not really generating the same growth that we had seen previously. Also, as we see here in the chart, corporate profitability has been declined pretty significantly in the first quarter, down 14% from the fourth quarter. In addition to that, I think this is a number that's likely to lag for quite a while. Anecdotally, businesses have been noting the additional costs that they're having to pay out to ensure the safety of their customers and their employees. As it relates to the pandemic, we expect those costs to continue for most of the year. Without generating significant profits, it's hard to imagine that businesses will be going out and making investments at the level they would need to drive economic growth. Okay, moving on to international trade. This is obviously, this is no surprise, the pandemic is a global concern. We've seen output from major economies across the world declining. The only which seems to be back in expansionary territory, albeit pretty mild expansionary territory, is China, who is sort of furthest along in their recovery process. This is a look at global composite PMI data, which shows that we are below that 50 line, which separates expansion from contraction. So a pretty sharp contraction still across the globe in terms of output. I think where I see that impacting the U.S. economy most is in terms of our outlook for imports and exports. Exports in the first quarter were down 8.7%. They're forecasted to fall an additional 33% in the second quarter and be down 7.5% for all of 2020. So unless we begin to see a pickup in activity outside of our borders, it's hard to imagine that we're going to see international trade be able to contribute meaningfully to overall economic growth. So what does all of that sum up to? I think this is the look at consensus estimates for U.S. economic growth moving forward. After the 5% decline we saw in the first quarter, economists are forecasting nearly a 35% decline in second quarter GDP, but then improvement in the second half of the year. So growth of 15% in the third quarter and nearly 8% in the fourth quarter. A lot of that growth in the second half of the year obviously has to do with the weak performance that we have seen and expect to see in the first half of 2020. But what that sets us up for is sort of beginning to sort of achieve rates of growth that are more than the potential theoretical potential rate of growth of the economy, which is right around 1.8 to 2%. So as we close the output gap that's opened up during the pandemic, we would expect to see growth sort of in excess of the theoretical potential of right around 2%. And that's what we're seeing here in the second half of the year. But the gap that's been opened up during the pandemic is obviously very, very large, and it's going to take quite a long time for the economy to close that gap entirely. This is a look at CBO estimates of the economic impact and how that will be affecting gross domestic product over the next decade. And as you can see, it takes the better part of that decade for us to be able to fully close the gap between what the economy's potential output is and what it actually will achieve. So it's a long road here ahead of us. We may see faster growth here in the near term, but faster growth on a quarter-over-quarter basis doesn't mean we're back to a healthy economy. We still have quite a long way to go, even after moving beyond 2020 and 2021. So some of the areas that we could see sort of increase that rate of growth that we're expected to see, increase the pace with which we might close that output gap, comes from the federal government and the Federal Reserve. So focusing here first on the federal government, the support that they've been giving to the economy related to the coronavirus exceeds what they did a decade ago, a little bit more than that, during the Great Recession. $2.5 trillion already has been injected into the economy by the federal government. through different stimulus bills. Things like expanded unemployment benefits, which we've talked about, the direct stimulus to households, as well as bailouts for the hardest hit industries. We're beginning to see more and more talk out of the White House and out of Congress about the likelihood of a phase 4, some additional spending that the government is planning on making. The form that takes is still up in the air. One thing that does seem certain is that a lot of the chatter out of the White House is that the extension of sort of the increased unemployment benefits that the government's been paying out, that seems less likely to be something that continues after they expire in July. Now, there's some concerns there about moral hazard, about those unemployed who are actually making more in unemployment benefits than they did while they were working, and that keeping people out of from rejoining the labor market. Instead, likely to see some incentives that would entice people who are unemployed to rejoin the labor market. The other half of the support that we've seen comes from the Federal Reserve. Early on in the pandemic, some of the financial conditions indicators that we watch were beginning to look pretty scary. We were seeing what looked like a search for liquidity, and investors were selling out of high quality assets to sort of achieve liquidity that they needed to raise cash balances. I think as looking back, the Fed took sort of decisive action, quick action, and I think really avoided what was a developing public health and economic crisis from becoming a financial crisis also. They've cut rates back to the zero lower bound. They've introduced unlimited asset purchases. And they've also created a number of lending facilities to support businesses of all types, small, medium, and large, as well as municipalities and money market support. We obviously had a Fed meeting this afternoon, which I haven't had a chance to review the press conference from the chairman today, but I did get a look at the statement. And the big news there is that the Federal Reserve is going to be sort of committing to purchasing treasuries in the amount of at least $800 billion on a monthly basis, and residential and commercial mortgage-backed securities in the amount of $40 billion going forward. So that support of the economy isn't going anywhere. We also had to look at some of the projections from Fed policymakers. All but 2 of those submitting projections saw the policy rate staying near zero through 2022, with an unemployment rate at the end of this year somewhere between 7 and 14%. I think that gives you a sense of how much uncertainty there is. That just the outlook for the unemployment rate could sort of be that diverse. Some of the things that I would look for moving forward from the Fed. There's been a lot of talk about negative interest rates here in the U.S. That's something that's been used elsewhere in other markets. I think that's very unlikely from the Fed. Policymakers have been pretty uniform and pretty consistent in saying that that's probably not a policy step that would make much sense for the U.S. economy. What I do think is more likely is that we'll see it's called yield curve control or yield curve targeting. Basically, what we would see is the Fed announced that they were targeting a specific area of the yield curve and were looking to cap interest rates. And the way they would affect that cap is by going out and making purchases in the open market. So this may sound a lot like the quantitative easing programs that we saw following the financial crisis. The one area where it's different is we're not targeting a level of asset purchases. We're targeting an interest rate, or basically the cost of that treasury debt. So potentially, if the Fed maintained its credibility, market participants could move the interest rates to the Fed's target without the Fed needing to go out and make the same level of purchases as they would under the quantitative easing programs that they implemented following the financial crisis. This yield curve targeting is something that's being used right now in Japan and Australia, and the U.S. used it during and after World War II to sort of keep borrowing rates down for the government. With all of the assets, the purchases by the Fed, the injection of liquidity, and the stimulus payments, the stimulus measures that the federal government is taking, I think there's some growing concern about consumer price inflation and the impact that all that money flowing into the economy is going to have on consumer prices. That's certainly a conversation that's going to be that's worthwhile to have. I'm not sure right now is the time to have it. As you can see, this is our look at core CPI and core PCE, both of which are trending down. This morning we had our CPI report, which showed that core prices fell 0.1% for the month. And it's actually the first time that we've seen core prices fall month over month in 3 consecutive months. So this is I think near term, I would be more concerned about a disinflationary environment, potentially a deflationary environment. Whereas I think that the conversations about inflation, which we've been having largely since the financial crisis, I think those can be delayed until the economy is on sounder footing. The final point I wanted to make as it relates to the economy is just to sort of discuss one of the ways that we've been trying to imagine what the post-pandemic economy might look like. We expect there to be changes, that the pandemic will affect. One of those is that if there's an underlying trend in the economy, something that's sort of been moving prior to the pandemic, but the pandemic brings to the fore, sort of accelerates that growth. That's something that we see continuing. So I think that the best example and the one that's perhaps the most obvious is e-commerce sales. As you can see, so e-commerce sales are included in the retail sales report as non-store retailers. E-commerce dominates non-store retail sales at this point. But as you can see from this chart, non-store retail sales as a percentage of total retail sales has been growing steadily over the last 20 years. But there's been a step change during the pandemic as more consumers have been confined to their homes and looking to purchase more and more of their goods online and have them delivered to their homes. So I do expect that e-commerce is going to be a much larger percentage of overall retail sales in the U.S. Than it was just prior to the pandemic. I don't expect we're going to fall back down to the levels where we were previously. Some other examples of this sort of shift where I would expect sort of a pre-pandemic, post-pandemic shift, grocery delivery. That's more of a new phenomenon over the last several years, but grocery delivery has become much more popular, consumers being introduced to that, and I think that's something that sticks. And then finally, the prevalence of remote work. I think it was sort of a great unknown prior to the pandemic, where we've all been asked to stay home and work from home, and I think that's something that sort of once that's been breached, that's something we might see more and more of, and that would obviously have implications for commercial real estate markets. And I think in addition to that, technology purchases and things like that. So that's one of the ways that we're thinking about the economy here. And that actually wraps up my portion of the presentation on the economy. I'd like to turn it over now to Jeff, who's going to be talking about financial markets.
All right, great, appreciate it, David. Now, not to belittle what David said, but I don't quite understand what he's talking about. He had all this historic excitement and economic activity plunging. But if we look at the financial markets, they yawned. They were boring. We saw the S&P index, essentially, this is as of Friday, essentially flat for the year. Barclays index, it was up, but single digits. Of course, I somewhat joke that if I'm leaving out the interim, which is all the volatility and excitement that we actually saw in the market. And if you look at, when the economy really went into lockdown and, the panic regarding the coronavirus or COVID-19 reached a crescendo, we actually saw, the S&P 500 decline about 34% over 23 trading days. And the magnitude and the speed of that drop are without precedent. And by comparison, at the start of the global financial crisis in 2008, it took roughly a year for the markets to fall by a similar amount. And just to give you kind of a sense of perspective here, is this S&P 500 over the last 5 years, you can see that, at its low point, it wiped out years of gains. It brought us back to levels that we hadn't seen since 2016. And you also see the speed at which that fell. So if you felt like the rug got pulled out from underneath you as an investor, you're somewhat correct. Now, being a pandemic, obviously there was nowhere really globally to hide. This is kind of a look at major indices in the first quarter around the world. We had the S&P down roughly 20%, but you look at developed markets and emerging markets, they were down in excess of 22%. Furthermore, you had the Russell 2000, which is more of a small cap index, that was down in excess of 30%. So really volatility in market declines around the globe. However, things were pretty rational. We look at how the sectors broke down, and we can see that a lot of the declines were occurring, the significant declines were occurring in the really cyclical areas, those areas that were going to be disproportionately impacted by the stay-at-home edicts. So, energy prices. I mean, I don't remember the last time that I actually fueled up my car during this time period. That you saw energy index fall roughly 50%. Industrials and materials likewise saw a collapse in financials with concerns over the potential defaults. Now, on the flip side, and why they did experience declines, those sectors that could actually profit or actually see their earnings hold up fairly well produced the lowest losses. I mean, infotech, as David mentioned, we had this huge transition to people having to work from home that led to a tremendous uptake in cloud computing, people having to go out and buy specific tech for their home offices. So that certain industries saw, actual gains in their earnings during this time period. Furthermore, I mean, the consumer staples, utilities, and healthcare tend to be traditionally more stable earnings. So while they saw losses, here again, they were not as great as what we saw in the cyclicals. So it kind of begs the question, if we saw these, big declines in the market, but now we're sitting at flat, what turned around the economy? And this is a real messy chart, and I've kind of done it for a reason. David alluded to the fact that we had a lot of governmental programs, and the Federal Reserve has been very active. And this chart shows each one of the black lines represents a Fed announcement of a new policy measure or an interest rate cut. We have some red lines. I apologize, the demarcation is somewhat hard to see, but the red lines represent the U.S. government actually implementing fiscal policy. And so what you can see is the tremendous amount of action that both the Fed and the U.S. government took as the market continued to fall. And really what they were doing is providing a bridge financing for the economy to get through this lockdown period. And so, ultimately, the economy started to climb its way out, or the market started to climb its way out of, these depths. And you can see as we move to the right, there's less and less action being taken as the government and the Federal Reserve have, kind of taken more of a wait and see approach to what the actions taken up to this point have done. And, it really, goes the speed and the magnitude that the Fed acted and the U.S. government acted, really is phenomenal. And what you also see, the U.S. government acted a lot quicker than a lot of international markets. And as a result, while the S&P is down roughly, flat, and it's actually, I believe it's up as of today, international markets are still down high single digits. And this is, I think, somewhat to the fact that a lot of these countries delayed taking actions or didn't take actions as aggressive as the Federal Reserve. We have seen, as things are starting to improve a little bit, we have seen money starting to flow and the dollar start to weaken a little bit. So we've actually seen some interest starting to percolate up in more international investing. But still, I think there's a lot more risk in those areas. The Fed and the U.S. government really somewhat backstop the economy with its actions to date. So, if we look at how things have played out actually year to date, I had the sector returns prior at the first quarter, and you saw the panic selling in the cyclicals and more of the improvement in the defensives somewhat continued to hold up. Here again, we see energy, industrials, financials being the worst performers, whereas tech, discretionary and commercial services actually producing positive returns. And so it does appear that the markets are being rational in their assessment of who is actually going to profit from the current lockdown and the current dislocation that we have in the economy. Now, I'd be somewhat remiss if I didn't bring up the FANG stocks. And for those of you that don't know, the acronym FANG stands for Facebook, Apple, Amazon, Netflix, and Google. And we added a plus M, that being Microsoft. And much has been made about these stocks and the performance that they've had and the outside influence that they are starting to have on the overall market. And now, given the size of these companies, which they represent over about 20% of the S&P 500 index, you know, their influence and their performance is going to have an outside impact in the overall performance. This chart, what we tried to do here is break these the performance of these stocks apart. The black line here represents the FANG stocks. The green line represents the overall S&P 500. And then the red line represents the S&P 500 less the FANG stocks. All of this was normalized to the beginning of the year. And what you can see is, you know, the FANG stocks, and here again, this was as of last week, you know, we're up about 19% for the year. The S&P 500 was down roughly 2%. Note that this is just a price appreciation. I told you we were flat, the flat meaning a total return, which includes dividends. But I think what the important point to show is while, you know, the total index is down 2%, you know, if you take out the FANG stocks, you're down actually closer to 5%. So they are having, you know, an outside influence on the overall index. Another important point to note with regard to the FANG stocks is that the price target that analysts have on these, on average, is about 6% higher than where we currently stand. So it appears that there's going to need to be a leadership change in order to significantly propel the market higher. Either that or analysts are going to have to reassess where they think the fair value of these stocks are. Now, one of the concerns that we have is the current valuation of the market. You know, things have really roared right back. And to assess that, what we've done here is we've taken the PE ratio. This is a forward price to earnings ratio, or the price of the index divided by the earnings of the index. But since 2020 is such a, you know, an abnormal year with, you know, everything being under lockdown, we actually are using the value of earnings for next year, for 2021. You know, and just to give you a point of comparison, you know, earnings are expected right now to only be about, you know, $125 per share for the S&P. Next year, they're expected to actually be 161. So definitely a recovery. But what this chart's showing is the red dots are at the upper end on across the board of all the major indices out there, which tends to indicate that the markets are a little bit overheated. Now, before everybody runs out and sells all their stocks and goes to cash, I'm going to point out that 1 year performance returns are very uncorrelated with actual valuations. What I think the best thing that we could say regarding the multiples that we currently trade at is that expectations for longer term returns should be lowered. This is one of my favorite charts here. It shows the 5-year annualized return as it relates to where the stock market's trading. And we've broken it up by decade. So you can see the salmon colored chart or dots are the 1990s, the green being 2000s, and the blue being the 2010s. So the dot's pretty far along, indicating that we're somewhat richly valued, but it is indicating of, you know, returns in probably the mid-single digit range. Now, another important point to note here is the certainty. We're using 2021 earnings, and so when you go out a couple of years, the uncertainty obviously goes up. Furthermore, we're in an economy that's just now opening up, and so we don't quite know how things are going to play out. And it appears that analysts are being somewhat conservative. Bloomberg recently noted that normally after a earnings trough, you know, you see an earnings recovery of about 10% after a recessionary trough. The current estimates for the next 2 quarters are actually only about 3.5%. So it appears that analysts are being very conservative. So if they are being overly conservative, then the valuation of the index might not be as rich as it's currently indicating. Important point to note, though. Now, jumping over into fixed income, you can clearly see it's risk off. These are year-to-date returns, risk off feeling in the market, with treasuries being up almost 7%. You know, the U.S. aggregate, which is kind of the S&P 500 of the bond markets, being up only about 5%. And you see, you know, corporate high yield bonds actually declining. Now, I know I've given a number of talks here, and the last few times we've actually been cautioning about the high yield market, and it looks like that actually was somewhat prescient. One thing I do want to point out is the preferred equity, which somewhat surprised us. Now, recall preferreds reside somewhere, they're kind of hybrid securities, somewhere between stocks and bonds. You know, they tend to pay higher dividends than traditional stocks, the 5 to 6% range, with these dividends being fixed. However, the dividends can be cut, but usually only after the common share dividend is cut. And they're also lower on the capital structure than bonds. They tend to be issued by financial institutions. So we weren't surprised that we saw some weakness here, but given the regulatory environment post the 2008 financial crisis, banks and financial institutions are in a lot better position to weather the storm. And so I think that this actually offers an opportunity going forward here as a point to possibly be a substitute for your traditional fixed income. Now, taking a step back and actually looking at how interest rates moved year to date, you know, at the start of the year, the 10-year Treasury was at a rate of about 1.92, which we actually, you know, going into the year felt that it was a pretty low level. But following, you know, the severe risk-off moves in the market, the Federal Reserve doing 150 basis points in interest rate cuts and implementing what was really an alphabet soup of lending facilities, you know, the 10-year bond fell to a low of roughly only 50 basis points. So, you know, it's recovered since as we're starting to get some of the positive data that David has indicated. But, you know, we're at 76 basis points. You're not seeing a great level of return. Furthermore, as David talked about, the Fed doesn't want to implement a negative interest rate environment. So it somewhat caps the upside to bond prices. And furthermore, if they do undertake yield control measures, then you might see interest rates be somewhat capped on the upside here as well. So I think the bond market, as it relates to the Treasury, could be somewhat boring for the next year and operate in a range. Now, we did, and we have alluded to negative interest rates, and a lot's been talked about that. And, you know, while we don't think the Federal Reserve is going to actually implement a policy of negative interest rates, it surprised some to know that negative interest rates actually occurred in the U.S. You know, you can see here, this is the 3-month Treasury. And what happened was there was such, you know, risk aversion that there was panic buying of the Treasuries, which pushed up the price of these, such that if you held the bonds to maturity, you were guaranteed a loss. So this really just indicated really the severe risk aversion that was prevalent in the market. Now, a couple other areas that I want to mention where I think we still see some opportunity. You know, the municipal bond market, I think we've talked about that in the past, and it traditionally sells at interest rates at a discount to treasuries. This is being because the municipal bonds tend to be tax exempt interest, and so, you know, the interest that they pay is actually worth more than taxable treasuries or taxable corporates. However, there's been a lot of worry about state and local finances due to the shutdown, and these are concerns are resulting in a yield spread, or actually, you know, positive yield spread, indicating that, you know, the yield on municipal bonds is actually higher than what it is on treasuries, which is somewhat of an anomaly. Now, we believe there is risk, but, you know, there's been talk in Congress about some relief for state and local governments, and things do tend to look like they are getting better. So we do think there's opportunity out here. Furthermore, given the unprecedented spending that the federal government's had to undertake, it's likely that taxes are going to have to rise in the future, which would make the interest associated with municipal bonds that much more attractive. And then one of the other things I wanted to mention, as I said earlier, the high yield spread market really sold off. Remember, as interest rates go up, bond prices go down. And we had been worried about this for a while. First, at the beginning of the year, we had cautioned that we thought the yield spread of under 3% wasn't compensating investors for the risks associated with the high yield market. Furthermore, we were worried about a bond bubble potentially growing in this, the lowest level of the investment grade space, that being the BBB rated bonds. And our concern was that we were going to see rating downgrades, and those, the flood of bonds falling out of investment grade and into high yield, really could swamp the market. These concerns are starting to play out, and we've actually seen, the credit spreads widen in anticipation of this. We've definitely been seeing a lot more downgrades of these BBB into junk recently. Now, the credit spreads have widened close to about 5%. So I think the market is being somewhat rational at current levels, and there is some opportunity for those, risk-seeking investors. But here again, I would only go into the high yield space and do a diversified investment, like a diversified ETF. With respect to the investment grade bonds, I do believe there is some opportunity here. We continue to recommend investing in bonds at credit ratings above BBB to watch out for that, bubble and the potential downgrade into junk. But I do believe there's probably a little better risk-adjusted opportunity in this space. So we've thrown a lot of data at you here, and I think we're going a little bit longer than I was hoping. But I wanted to kind of wrap it up so we can get to some Q&A here, because I always tend to enjoy that the most. In summary, we have seen unprecedented declines in economic activity, but those declines appear to have bottomed out in the April-May timeframe, and it's starting to improve. Now, markets have rebounded, but the recovery, it does look rational. One thing to note is, I've heard it said in the past, and I actually think it's very prescient, is the market doesn't react necessarily to the level of economic data, but more the trend. And the fact that the trends are starting to get better, the market's forward-looking, and it's starting to discount that. And that's why we've seen the markets recover, even though the actual data is still somewhat dire. Now, current valuations are high, but analysts are being conservative, which it might indicate the valuations, are artificially elevated. But I do believe the pace of economic opening is going to be crucial to things going forward. Now, the last bullet is what I want to leave you with, is I think the economic lockdown will have some long-lasting impacts on society. As David mentioned, we've seen some acceleration of ongoing trends, most notably e-commerce, but it will likely also produce several other changes in the way we work and live. It's going to create opportunities for new entrants to really disrupt the status quo. It's also going to create a lot of risks for existing established companies. And what I think is going to be key is to monitor how we emerge from this lockdown and try to seek companies that are innovative and are essentially trying to capitalize in the structural shift. So with that, I would like to thank you all for your time today, and I want to turn it back over to Alex and open up questions.
All right, thanks for providing those insights, guys. It looks like we have a couple questions here, and I just wanted to remind everybody really quickly that if you do have a question that you haven't asked yet, please just go down to the bottom of the screen. You'll see there's a chat function. Go ahead and type in your question, and then just send it to Alex Dietz, and I'll go ahead and relay those questions over to the two presenters. But just starting with one of these questions we have, I think this one's geared for David. So won't the amount of money that the Fed and the government, the amount of money that they're pumping into the economy, won't that create an inflationary environment? And how do you kind of view that happening over the next year to couple years?
Sure. So as I mentioned in the presentation, since the financial crisis, when the Fed undertook some large-scale asset purchases, and the federal government provided significant stimulus. That's been the concern from many, is that all this money flowing into the economy eventually would start to would create uncontrolled inflation. And if you look at the inflation data since the financial crisis, that really has never materialized. And so, I mean, those concerns are not new. I would sort of understand them. I share them. I think if you look at the near-term data, it's pretty clear that we're not sort of seeing inflationary forces being stimulated right now. And so we would look for sort of reversal there before we would become more concerned about that. Another point is that the Fed actually has some pretty robust tools for fighting inflation in terms of its monetary policy toolkit. So would actually be more concerned if this disinflationary or even a deflationary environment materialized. I think that would be a larger concern for the economy and for markets. So yeah, I understand those concerns. I recognize them. I think just now the conversation now shouldn't be about pulling back on those steps that are meant to sort of provide some solid footing for the economy. Let's have that discussion at a later date.
Thanks, David. Looks like we're getting some more questions in here. I think, Jeff, this one's probably a good one for you. If we're years away from being back where we were before the downturn, I think in terms of economic data, is the current market irrationally euphoric in the short term?
Well, I think we're looking at somewhat at apples and oranges here. The data that David was showing was economic gap or economic output, and that's for the economy as a whole. And there's obviously going to be winners and losers in the economy, and I think it really depends on how you're looking at things. Furthermore, we're also talking about the S&P 500 gets roughly 50% of its earnings from international sources as well. So, I think it's more complicated than just looking at the CBO's estimates of where things are coming. Furthermore, one of the things that might come out of this is, companies, did learn how to, maybe operate a little more efficiently. They might be able to reduce cost in having people work from home, work remotely, instead of people actually, working and punching a clock. Maybe they're going to become more, product or more, product specific, tied to their work, outcome based. And should that include, we could actually see an increase in productivity. The other thing I've heard, which is somewhat good and somewhat troubling, is the aspect of people working from home has really shown the outsourcing of white collar jobs might be actually a more risk right now. We've actually seen some people talking about reshoring manufacturing, but we're also seeing the talk about offshoring more the white collar jobs. That could be a detriment to the U.S. worker, but for companies, I actually see it be able to increase profit margins. So I do think there could be some levels of irrational investing in the market, but overall I think the market tends to be a fairly good forward indicator. But I do think as things open up and as we see the economy start to emerge, we'll guess that. And I guess one other thing to kind of, leave you with too on that is the federal government and the Fed in essence have pumped roughly about a quarter of annual GDP in monetary and fiscal stimulus into the economy. And that money had to go somewhere, and it's going to have to go somewhere. And David noted there's huge savings rates. So, we could see a snapback here should people feel more comfortable in their financial status here as we enter the second half of the year.
All right, thanks, Jeff. David, I think we got another question for you here. What is your view on the ever-growing federal debt and our country's ability to service this debt in the years ahead? So basically, in a shorter version, when is our nation's debt level unsupportable?
So I think one of the common misconceptions about the debt is that it needs to be paid off at some point. In fact, I mean, the U.S. economy isn't, or the U.S. government isn't like a household, as many people try to compare it. It's really about servicing that debt. And so it's a better ratio to look at is the level of debt relative to GDP. And then the other thing to focus on is the debt service cost. So how much is in interest payments is the government having to make? How much is that a percentage of the government's overall budget? And one thing that's likely to help here is as we talked about, we're expecting the Federal Reserve to keep rates low, to potentially institute some yield curve control to keep yields further out on the yield curve low also. And those two things, whether this is the intention or not, make servicing that debt as it comes due, makes it a little bit easier for the federal government. So again, I see this sort of similar to the questions about inflation. These are important questions that need to be tackled, but sort of being concerned about the level of debt when we're sort of plunging into an economic crisis, it seems the timing is off there. And I would suggest that we sort of focus on not just on the level of debt, but on our ability to service that debt.
Great. Jeff, I got another question for you, and I think this is on top of a lot of people's minds. So what happens with the resurgence of coronavirus? What are the risks there?
It's obviously a risk and something that we are monitoring on a daily basis. There's a number of models out there, most notably, I think the University of Washington, that does show that we've passed the peak. But a lot of people are worried about a second wave. I think one of the things that I find a little bit, I guess, more comforting is the healthcare industry and the U.S. government. The radar is up on finding and trying to tamp down hotspots of this virus. And I think Johnson & Johnson, their CEO, made some comments the other day to this end. And he said, they could foresee a second wave occurring in the second half of the year. However, they think it wouldn't be as bad. He said the economy or the government is more prepared. We have a lot more PPE, a lot more ventilators waiting. So if we did see the second wave, we probably would see maybe more localized quarantines as opposed to a whole, economy-wide quarantine. But it is a risk. I think the most important thing that for all of us is for there to be a vaccine. I know the government and companies are working as fast as they can on that, but it's not likely that we'll see anything before year end. Most estimates I've seen are probably still another year out before they actually have a workable vaccine for this. So we will have to be very vigilant. It's one of these things I think it's kind of missing in the headlines right now that, we are, globally, we're still seeing really high levels. But in the U.S., things appear to be still trending down, although I think there is some worrying, pockets of increasing cases here, specifically after, people kind of let caution go to the wind after Memorial Day.
Great. All right, we're going to do about 2 to 3 more questions. David, this one's for you. What trends do you see within residential and commercial construction activity in 2020, 2021, and even beyond 2021, specifically versus what we were seeing in 2018 and 2019?
Yeah, I think as it relates to the residential housing market, we were beginning to see sort of what was turning into a nice market for housing in 2020 prior to the pandemic. Obviously, the construction industry has been hard hit. It was one of the hardest hit industries. We did see a nice rebound, as I mentioned, in May. So hopefully construction activity begins to pick back up. I do think on the residential side, I would expect that we're going to see the low level of mortgages really stimulate a lot of demand. We should see some new buyers. This all is sort of predicated on the housing market continuing to improve. But I'm optimistic. I think we've seen some nice data out of the National Federation of Home Builders, and so I think the housing market right now is constructive. Just as soon as we sort of adjust our housing industry for construction in terms of allowing for some social distancing, as well as sort of stimulating demand for existing home sales also. I think there's an opportunity that we could return to strength. I think maybe by later in the second half of the year, we would potentially be lined up for some improvements there in the housing market.
And Jeff, got a question on, this is also, I think, a hot topic here is, everybody's been wondering when are value stocks going to finally outperform growth stocks? Is this the year you think that's going to come to fruition?
Yeah, we get this one a lot, and I tend to not like the classification of value versus growth, specifically because the way we look at things is a discounted cash flow, and this becomes important in this whole topic. If you have a growth company that's growing phenomenally, and you look at that and you forecast those cash flows out, and you discount it, and you find that it's trading under the net present value of that stream of income, well, then you have a growth value that's in essence a value stock. Likewise, you can have a value company that is trading at a low multiple, but if you're looking at the growth and there's just no growth or declining growth, that quote unquote value stock might actually be considered overvalued. But I think the important point to note here is the way these companies are valued, and that being the net present value of earnings. So if you think of a stream of earnings over the next number of years and you're discounting those back, you're discounting them back usually by a rate that is locked or is influenced by the U.S. Treasury, or a risk-free rate. And so with the U.S. Treasury being so low, what happens is that discount rate becomes a lot lower. And in essence, growth companies who might be seeing a lot of their earnings potential out in future years, if it's being discounted lower, those stocks become more valuable just because of the mathematics behind that. Now, with our outlook that interest rates are going to stay low at these levels, I don't think this is going to be a year where you see your traditional, quote unquote value stocks outperforming growth, just because I think that discount mechanism is still going to favor the growth stocks.
Thanks, Jeff. And I got one last question for you, and it's your favorite one. We got a couple of people asking the same question. So, how do you believe the market will be affected by either the re-election of Trump or the election of Biden?
I figured that we were going to get an election question here coming up. I think, to me, looking at these things, we could see knee-jerk reactions. We tend to be longer-term investors, and I think everybody got it wrong the last time when Trump got elected. I think the general consensus was the market was going to sell off, and then in fact rallied. And so making predictions about a specific person or a specific outcome of election, I think is really hard. The one thing I would note is the economy tends to do, and the market tends to do better when you have a split administration, meaning that Congress is either split or the other party versus the administration or the president. And should we get a Biden administration and Congress remains split, or Trump administration and Congress remains split, I think the economy is going to continue to march along. The big unknown, I think, was going to be with respect to taxes. Obviously, if Trump gets elected, I think it's going to be hard to get any further tax cuts. Whereas if Biden got elected, I think tax increases are on the table. So that could have some major repositioning. But with respect to the overall market, I believe that we're going to still have a split Congress. And so I don't believe, other than really knee-jerk reactions, it's going to be materially different under either administration.
Great. Thanks, guys. Well, unfortunately, we are out of time. I'm sorry we're not able to get to every single question, but I'd like to thank both David and Jeff for providing clarity in these highly uncertain times. Just as a reminder, this presentation was recorded and it will be available on our website for replay within the next few days. Also, should you have any further questions, comments, or suggestions on future presentations, I would encourage you to contact your portfolio manager or business development manager. Thanks for all attending today, and I hope you have a great day. Looking forward to doing more of these in the future.